You put in the effort. You budget and save. You're doing everything by the book. But financial freedom still seems out of reach. Instead of growing, your money feels like it's quietly disappearing. You might be thinking the problem is that you're not earning enough. But what if the real issue is where you're keeping your money? There are places we've been taught are safe, recommended by banks, financial advisors, even our own parents. But some of these so-called safe spots are quietly draining your wealth. If you're over 40 and want to protect your future, avoid common money traps, and finally build lasting financial freedom, this episode of Profitability Plus was made for you. Today, I'll share 10 money spots that are not as safe as they seem, and what you can do instead to protect and grow your hard-earned savings. Let's dive in. 1. Traditional savings accounts. We've all been told that keeping money in a traditional savings account is responsible. But the truth is, your money is shrinking there, slowly, but surely. Most traditional savings accounts offer a return between 0.01% and 0.5%. Meanwhile, inflation has averaged around 4% in recent years. That means if you save $10,000 for 5 years in one of these accounts, you might earn $250 in interest. But you'd lose over $2,000 in buying power. Your money isn't just sitting. It's losing value. And the bank? They're lending it out at 8% to 12% interest and keeping the profit. What can you do instead? Switch to a high-yield savings account. These are still FDIC insured, but they offer interest rates of 4% or more. Banks like Ally, Capital One 360, and Marcus are examples. It takes just minutes to open one online, but the long-term difference it makes can be significant. 2. Keeping too much cash at home. It might feel smart to keep emergency cash at home. After all, what if something happens with the banks? But keeping large amounts of cash at home is a hidden risk. Physical cash doesn't earn interest. It's also vulnerable to theft, fire, or loss. Let's say you keep $5,000 in a safe at home for 10 years. If inflation averages 3%, your money will lose about $1,300 in purchasing power, even if you never touch it. That's like watching your money melt. According to the Federal Reserve Bank of Boston, Americans are storing over $500 billion in cash outside of banks. That's $500 billion losing value daily. So, how much cash should you actually keep at home? Most experts suggest $500 to $1,000. Enough for short-term emergencies. The rest should be in secure, interest-earning accounts. 3. Certificates of deposit, CDs. CDs are another tool we're told are safe. You deposit money for a set period, 6 months, a year, even 5, and earn a fixed return. But here's the issue: you lose access to your money during that time. If you need it early, you pay penalties, sometimes giving up all the interest you earned. For example, Bank of America charges a 90-day interest penalty if you withdraw early from a 1-year CD. That's a big chunk of your earnings gone. Even worse, most CD rates don't beat inflation. So after locking your money away for a year, you could end up with less purchasing power than when you started. CDs might make sense if you're absolutely sure you won't need the money. But for most people looking for liquidity, they're a bad fit. They look like a safe choice, but they're a trap that limits your access and slows your growth. 4. Permanent life insurance. You've probably seen the pitch: life insurance that protects your family and grows your money. Sounds ideal, right? Permanent life insurance products like whole life or universal life are marketed as smart investments, but most of the time, they aren't. These policies have high fees, complex structures, and often underperform. Only part of your premium goes toward actual insurance. The rest goes into a cash value account, but this account grows very slowly and is loaded with hidden fees. Returns often hover around 2% to 3%. And here's the shocking part: when you pass away, The cash value you've built usually does not go to your family. The insurance company keeps it. You pay for decades, thinking you're building wealth, only to realize your family gets just the death benefit, not the savings. What's the smarter alternative? Term life insurance. It's simple, affordable, and is what insurance is supposed to do: protect your family if something happens to you. Companies like Haven Life, Bestow, or Ladder offer competitive rates with easy applications. And the money you save on premiums? You can invest it yourself in low-cost index funds with better returns and more control. 5. Vehicles and other depreciating assets. You may be proud of owning your car outright. But here's something many people misunderstand. A car is not an asset that builds wealth. Real assets generate income. Vehicles do the opposite. Cars cost you money every month, through insurance, gas, repairs, and taxes. And they lose value over time. The American Automobile Association reports that the average cost of owning a car is over $9,000 per year. That's $750 a month that's not going into savings, investments, or your future. Some people even put vehicles into living trusts, thinking it helps with estate planning. But doing so can expose your estate to legal complications if there's an accident. Instead, see your vehicle as a tool, not an investment. Minimize costs where you can, and don't buy more vehicle than you need. That money is better spent elsewhere, like building assets that grow in value. 6. Timeshares. Timeshares are often sold as a way to enjoy luxury vacations without the full cost of owning a second property. They promise beautiful destinations, fixed schedules, and lifetime memories. But in reality, timeshares are one of the most misleading financial traps out there. You're not buying real estate in the traditional sense. You're buying the right to use a property for a limited time each year, usually 1 or 2 weeks, and paying annual maintenance fees on top of the initial purchase price. These fees tend to rise over time, regardless of whether you use the timeshare or not. And if you've ever tried selling a timeshare, you know it's nearly impossible. The resale market is flooded with people practically giving them away. That alone should tell you how little real value they hold. True vacations should bring peace, not stress. Instead of locking yourself into a timeshare contract, consider renting or using travel rewards points. You'll gain flexibility, save thousands of dollars, and avoid the frustration of hidden fees and blackout dates. 7. Employer stock overexposure. It can feel like a vote of confidence to invest heavily in your employer's stock, especially if the company is doing well. But here's the problem: your job, your income, your benefits, and your stock are now all tied to one company. That's a risky concentration of your financial life in a single place. If the company hits a rough patch or layoffs begin, you could lose both your paycheck and a large portion of your savings at the same time. We've seen this happen before. Think Enron or Lehman Brothers. Employees lost their jobs and their retirement savings all at once. The smarter approach is to diversify. You can still invest in your company stock if you believe in its future, but experts recommend it be no more than 5 to 10% of your total investment portfolio. This way, you're not putting all your eggs in one basket, and your financial future isn't dependent on one company's performance. 8. Outdated or underused subscriptions. This one might seem small, but it quietly chips away at your financial well-being. Subscriptions and memberships, from streaming services to unused gym passes, often continue long after we stop using them. It's easy to forget about a $12 monthly charge here or a $30 service there. But these add up. The average household wastes hundreds of dollars a year on subscriptions they barely use or don't even remember signing up for. Take a few minutes to review your bank or credit card statements. Look at every recurring charge and ask yourself, do I really need this? Is this still adding value to my life? You'd be surprised how much money you can reclaim simply by canceling a few things that no longer serve you. That money can be redirected into a savings account, emergency fund, or investment that grows over time. 9. Low-return retirement accounts. Many people put their money into retirement accounts thinking it's automatically growing. But not all retirement accounts are created equal. Some are filled with outdated investments, high fees, or conservative allocations that no longer suit your age or goals. Worse, some people have multiple old 401ks from previous jobs just sitting idle, not growing, not optimized. These forgotten accounts can suffer from poor fund choices or high administrative fees that slowly drain your balance over time. It's important to actively manage and consolidate your retirement savings. Roll over old 401ks into a single IRA where you have full control. Choose low-cost index funds or ETFs that match your timeline and risk tolerance. Retirement isn't just about putting money away. It's about putting your money to work. If your retirement savings are just sitting there, they might not be doing enough to support your future. 10. Keeping too much equity in your home. This might sound surprising, but having too much of your wealth tied up in your home can limit your financial flexibility. Yes, owning your home outright feels secure. But in financial terms, that equity is locked in and not producing income. Imagine having $300,000 in home equity, but struggling with cash flow or missing opportunities to invest elsewhere. That equity could be working harder for you. Now, this doesn't mean you should cash out your home irresponsibly. But in some cases, using a portion of your home equity, through a home equity line of credit or other safe methods, can give you access to funds for smarter investments or emergency needs. The key is balance. Don't treat your house like an ATM, but don't let it be a vault that holds your wealth hostage either. Financial freedom is about having options and knowing when to use your resources wisely. The biggest threat to your financial freedom isn't always a lack of income. It's where your money is sitting. Places we thought were safe, traditional savings accounts, CDs, cash at home, permanent insurance, even your car or timeshare, can quietly drain your future. Now you know better. These insights are powerful, but only if you take action. Audit where your money is parked today and ask yourself, is it growing? Is it protected? Is it serving me? If this video opened your eyes, share it with someone who might need this information too. And let me know in the comments which of these 10 places surprised you the most. You've worked hard to earn your money. Now it's time to make sure it works just as hard for you. Thanks for watching Profitability Plus. See you in the next video.